Your screen shows silver at $66 per ounce right now. But in China, the world's largest physical silver market, there's only one seller left on JD.com, and they're charging $128, $50 for small raw bars. That's a 93% premium, double the official price. And it's not just China going dark. Perth Mint, sold out. Royal Canadian Mint, sold out. TD Bank. Canada, zero inventory. Japan's Asahi refinery, empty. The paper price is a lie, and the physical market just exposed it. Stay locked in because in the next 12 minutes, I'm exposing the real story. How Rongtong Gold, China's largest silver trading platform, froze all bulk silver sales overnight. And why only one merchant remains on JD.com, demanding $180 to $128, while $66 flashes on your screen. The shocking proof that London lease rates hit 39% annualized during the October panic. How China exported a record 660 tons in 1 month and still ran to decade-low inventories, and why this two-tier pricing system signals the complete breakdown of the paper silver market. This isn't theory. This is documented evidence from the world's biggest physical markets showing the paper price has become completely detached from reality. By the end of this video, you'll understand why the $66 price on your screen might as well be fiction. Let's go deep. Here's what just happened in China. Rongtong Gold, the leading online retailer at Shuibei Market, China's largest precious metals trading hub, has frozen all silver sheet sales. Not limited, not restricted. Frozen. Bulk purchases? Impossible. Wholesalers trying to order? Locked out. Industrial users who need silver for manufacturing? Out of luck. This is the largest platform in the world's biggest physical silver market, and they just shut the doors. But it gets worse. JD.com, China's dominant e-commerce platform, think Amazon of China, shows that nearly all merchants have delisted raw silver bars. Gone. Vanished. Removed from the platform. Only one lone seller remains. And look at their prices. $108.25 per ounce for raw silver. $128.50 per ounce for small raw bars. The paper spot price? $66. That's not a markup. That's not dealer greed. That's reality. When you actually try to buy physical silver in the world's largest physical market, this is what it costs. Buyers seeking larger quantities hit product pages marked out of stock or face indefinite waiting lists with no delivery date. 1 ounce collectible bars and themed packaging occasionally surface. But actual bulk silver? What kind of industries need? What kind of serious investors want? Gone. And this isn't isolated to China. Australia's Perth Mint, one of the world's most trusted mints with centuries of reputation, has stopped selling silver across its entire retail and wholesale catalog. Not a single coin, not a single bar. Complete shutdown. In October, they cited production capacity constraints. Translation, they can't source enough silver to keep operating normally. The Perth Mint supplies buyers across the Asia-Pacific and beyond. That pipeline, severed. Canada's TD Bank, the flagship retail bank and major bullion provider, shows every single silver product as unavailable. Institutional buyers can't purchase. Every day, savers see empty shelves. No restock timeline, just nothing. The Royal Canadian Mint completely shut down distribution of 10-ounce and 100-ounce silver bars. These aren't collectible coins. These are the lifeblood of institutional silver demand. The bars that industrial users and large investors depend on. Gone. The U.S. Mint. Silver Eagle production collapsed to just 20% of last year's output. Buyers face record premiums and month-long delays. South Africa's Rand refinery halted silver Krugerrand production entirely. Japan's Asahi Fine refinery, renowned globally for premium quality, zero silver availability. India? Some dealers on Amazon are taking orders, accepting payment upfront, and then defaulting on delivery. They literally cannot source the metal to fulfill paid orders. This is a global supply crisis. So what's actually happening here? We're witnessing the birth of a two-tier silver market in real time. Tier 1, the paper market, COMEX futures, London spot prices. What Bloomberg shows, what your trading app displays, $66 per ounce. Tier 2, the physical market, actual metal you can hold. Real bars and coins you can take delivery of. $108 to $128 in China. Record premiums everywhere else. The paper price has become meaningless. Think about it logically. What good is a 66 spot price if you literally cannot buy physical silver anywhere near that price? During the October 2025 squeeze, London lease rates spiked to 39% annualized. Let me repeat that. 39%. That's not a normal market. That's panic. Banks unable to locate sufficient metal were forced to buy back futures contracts or scramble to deliver actual silver. moves that spark explosive overnight price surges. The crisis has bifurcated the market completely. Futures and paper contracts trade at one price. The real metal, it commands far greater premiums, sometimes double the spot rate due to scarcity. Refiners and dealers across Asia report near zero physical availability, with buyers offering premiums above exchange prices just to secure any metal. Some Indian funds halted new silver ETF investments until supply stabilizes because they literally can't source enough physical metal to back new shares. When you can't back paper claims with physical delivery, the paper becomes worthless. Now let's talk about why this is happening. Shanghai Futures Exchange silver stocks dropped to just 531 kilograms in late 2025, the lowest level since 2015. That is a decade low. China, the world's manufacturing powerhouse and largest physical silver consumer, is running on fumes. In October 2025 alone, China exported over 660 tons of silver to London. That's an all-time record monthly export. Why? Because London was in such desperate shortage that China had to drain its own stockpiles to prevent a complete meltdown in the global trading system. London lease rates had spiraled above 30 to 39%. That's a signal of absolute panic where banks literally cannot find metal to cover their obligations. So China ships 660 tons, a record, to ease the crisis. But here's the kicker. Even after shipping 660 tons to London, Shanghai's inventory is still at decade lows. The market moved into backwardation, where near-term spot prices trade above later-dated futures contracts. Backwardation is a technical signal screaming, "We're out of metal." In a normal commodity market, you pay a premium for future delivery to cover storage and financing costs. That's called contango. Backwardation is the opposite. You pay more for metal today because there's not enough available now. When silver goes into backwardation, the market is literally telling you physical supply is gone. COMEX warehouse inventories crashed, D2. Registered stocks declined 70% from 346 million ounces in 2020 to just 82 million ounces by late 2023. In the first 4 days of December 2025, another 47.6 million ounces were claimed for physical delivery. The vaults are being systematically emptied. But why is this crisis happening? Because we've been consuming more silver than we mined for 5 consecutive years. The cumulative deficit from 2021 to 2025 totals approximately 820 million ounces. That's equivalent to an entire year of global mine production. Just consumed, gone, unavailable. Global silver mine production, approximately 813 to 820 million ounces annually. And that number has been flat. Total silver demand in 2024, 1.2 billion ounces. We're consuming 400 million more ounces per year than we're mining. Where's that deficit coming from? Above ground stockpiles built up over decades, and those stockpiles are running out. Available free float silver dropped from 850 million ounces to just 150 to 200 million ounces. That's a 75 to 82% decline in readily available physical silver. The solar industry alone consumed 197.6 million ounces in 2024, with projections showing 300 million ounces annually by 2030. Electric vehicles use 25 to 50 grams of silver each, double what traditional cars use. With 17 million EVs sold in 2024, the pressure is exploding. AI data centers need 2 to 5 grams of silver per server motherboard. Global IT power capacity increased by 5,252% since 2000. Every new data center adds demand. Electronics consumed over 460 million ounces annually. And here's the critical factor. 72% of silver comes as a byproduct from mining other metals like copper, lead, and zinc. You can't just make more silver when prices rise. Silver supply is tied to demand for those base metals. New silver mines take an average of 12 years from discovery to production. There's no quick supply response, no cavalry coming over the hill. So here's the question everyone should be asking. How can spot prices show 66 while Chinese buyers pay 128? Because the paper market and physical market have completely decoupled. The COMEX, London spot market, futures exchanges, they're all paper trading systems, contracts that rarely result in physical delivery. Historically, fewer than 2% of precious metals futures contracts result in actual physical delivery. The system was designed for cash settlement, not metal movement. But when large numbers of players start demanding physical delivery at scale, the system breaks. On October 2nd, 2025, silver entered persistent backwardation with spot prices exceeding December futures by up to $260. That means the market was so desperate for physical metal that buyers would pay $2.60 more for metal today than for a promise of metal in December. By mid-October, backwardation spreads reached up to $3,000 per contract in extreme cases. The COMEX December 2025 contract traded at $48.56, while spot silver on the LBMA sat at $51.04, a 2.48 disconnect. But in China, physical buyers were paying $108 to $128. The pricing reflects desperation. When you need physical silver for industrial production or investment, and you can't find it anywhere, you pay whatever it takes. And increasingly, metal isn't available at any price. Here's what most people don't understand about the global silver infrastructure. The London Bullion Market Association, LBMA, the hub of all global silver trading, has seized up. In October 2025, London's available silver inventory plunged 48% in a matter of weeks, from 280 million ounces down to just 145 million ounces. Half of London's available silver vanished. The situation got so desperate that they were literally airlifting silver from New York to London on cargo planes. Silver is heavy. Air freight across the Atlantic is enormously expensive. This is normally unprofitable. But dealers were paying whatever it cost because the alternative was default on contractual obligations. Bloomberg reported traders were booking space on transatlantic cargo flights to capture an $8 premium in Shanghai, compared with COMEX prices. $8 per ounce premium just for getting metal from one location to another. That's not arbitrage. That's a distribution system in crisis. Mike Maloney, founder of Gold Silver. Com calls this the unobtainium stage, where metal isn't just expensive, it's unavailable at any price. This is when you get triple-digit silver prices and gap-ups overnight, when physical markets rip control away from the paper paradigm. And we're watching it happen. China is paying $128, while your screen shows $66 is the physical market taking control, when the world's largest physical market prices, metal 93% above the paper price. That's not an anomaly or regional premium. That's the new reality. And there's one more bomb about to drop. China is implementing export restrictions on silver effective January 1st, 2026. Silver has been added to China's list of tightly controlled exports alongside rare earth minerals and other strategic materials. China controls up to 70% of the global silver supply chains through mining, refining, and manufacturing. When those export restrictions hit, global availability could drop by thousands of tons annually. After January 1st, the silver shortage could increase by more than 2,500 tons per year, according to industry estimates. The same country that just drained its inventories to decade lows by shipping 660 tons to London, they're about to stop exporting. What happens to global silver prices when China cuts off supply? Here's the bottom line. Physical silver has vanished from global markets. China's largest platform froze sales. JD.com is down to one seller charging $128. Perth Mint, sold out. Royal Canadian Mint, sold out. TD Bank, empty shelves. Asahi Refinery, zero inventory. Shanghai at decade-low stocks, despite shipping record 660 tons to London. 5 consecutive years of supply deficits totaling 820 million ounces. An entire year of mining production just gone. Paper prices are showing $66. Physical prices are at $188 to $128. The two-tier system is here. The disconnect is widening. London lease rates hit 39%, absolute panic levels. Backwardation spreads are reaching $3,000 per contract. Metal is being airlifted across oceans because the global distribution system has broken. And on January 1st, 2026, China starts restricting exports. The paper price on your screen is becoming meaningless. The physical market has taken over. When the COMEX can't deliver, when London vaults empty completely, when the last ounce of free float metal disappears into industrial demand, that's when paper contracts become worthless. That's when price discovery shifts entirely to physical markets. That's when $66 becomes $128, and then $150, and then $200. The Vanishing Act is complete. The exposure is undeniable. The paper market is dead. It just doesn't know it yet. If this opened your eyes to what's really happening, smash that like button. Subscribe for more exposés on what markets are hiding. Drop a comment. Do you think paper silver survives 2026? Or is physical the only price that matters now? The two-tier system is real. The breakdown is here. The reckoning is coming. Don't say you weren't warned.